Hi everyone, I'm Shruti and welcome to G2 Financetech's weekly market update. Your concise breakdown on what moved the global markets and why it matters to you as an investor. This week, it was all about labor resilience, central bank signals, and cautious optimism. Let's get into it, starting with the United States. United States, cooling jobs, strong tech, and tariff watch. US markets closed higher for the second week straight. The Russell 2000 led the charge, rising 3.19%, followed by gains in the Nasdaq 2.18% and the Dow 1.17%. Notably, all four major indexes are now in positive territory for the year. Tech stocks stole the spotlight again thanks to AI tailwinds. Meta's 20-year clean energy contract with Constellation Energy for powering its AI infrastructure added to the bullish mood. Trade tensions simmered early in the week as Trump's social media post reignited concerns over China. But by Thursday, things turned a corner with a phone call between Trump and Xi yielding what Trump called a very positive conclusion. That helped calm markets. The labor market gave us mixed signals. Friday's non-farm payroll report showed 139,000 jobs added in May, softer than April, but still above expectations. The unemployment rate held steady at 4.2%. Markets cheered the outcome and treasury yields moved higher on the news. Manufacturing stayed in contraction for a third month, PMI at 48.5, while services surprised negatively, dipping to 49.9, the first time in 11 months. Inflation, especially on the input side, remains sticky, a story we'll be watching closely. Europe. ECB cuts, GDP upgrade, and output pressure. Europe was in a better mood. The Stoxx 600 rose 0.9% on the back of slowing inflation and the Europe Central Bank's first rate cut since 2022. ECB President Lagarde noted that cycle is nearly concluded, though markets are pricing in one more cut later this year. Growth was surprisingly upbeat. Eurozone GDP was revised up to 0.6% for quarter 1. Inflation now back under 2%, but industrial output in Germany and France came in weaker than expected, revealing some cracks underneath the surface. In the UK, Governor Andrew Bailey remains dovish but cautious, suggesting that while the direction of travel for interest rates is down, the journey ahead remains foggy. Japan. Weak spending, policy tightrope. Japanese markets slipped this week with the Nikkei down 0.59%. Trade talks with US remain inconclusive but ongoing. Investors are hopeful for an announcement by the G7 summit in June. Yields on Japanese government bonds dipped slightly after rising concerns last week around fiscal stability and aggressive Bank of Japan tapering. The central bank may consider slowing bond tapering next year. Household spending disappointed, falling 0.1% year on year, while real wages also shrank 1.8%. Still, the Bank of Japan reiterated its readiness to hike if inflation continues to materialize. China. Weak data raises stimulus hopes. Chinese equities moved higher with CSI 300 up 0.88%. The latest Caixin PMI showed manufacturing slipped into contraction at 48.3, its weakest since 2022, thanks largely to smaller exporters bearing the brunt of US tariffs. Services offered a bright spot at 51.1. The official PMIs released earlier painted a more stable picture, suggesting the short term reprieve on tariffs may be helping. Stimulus chatter is back. The PBOC has already made some easing moves, and expectations are mounting for more as China looks to balance growth and trade damage. Our take. This week's data tells a story of cautious optimism. Jobs are holding up, central banks are taking calculated steps, and China is quietly laying the groundwork for stimulus. But beneath the surface, uncertainties around trade, inflation, and fiscal deficits continue to bubble. At G2 Financetech, we believe staying diversified and tuned into policy shifts is key. Volatility isn't always a threat. Sometimes it is an opening. Thanks for tuning in. I am Shruti and I'll be back next week with more insights from around the world. Until then, stay curious, stay informed, and stay ahead. Thank you.